bit with a 101. I mean, I think many of the audience understands that the first hedge fund founded by Mr. Jones in the late 40s, and it was kind of this private exclusive club. There weren't many of them, and that has really, really changed in the last 5, 10, 15 years. But why don't we start with define, per your perspective, what is a hedge fund?
Absolutely. Hedge funds are quite simply active investment strategies, but with an additional component called active risk management. And that's kind of a very important aspect of thinking about a hedge fund. We don't view hedge funds as a separate asset class. Rather, we view hedge funds as having a much more unconstrained view of what the investment opportunity set should look like for a manager. So managers are looking at different types of underlying securities, but more importantly, on top of that, there is an element of risk control at the portfolio level, which is a very important part of differentiating a hedge fund from an active long-only manager.
Yes, and I think yourself and much of the audience will agree with me, maybe a little bit of a misnomer that hedge funds per se are a separate asset class. They're using much of the same assets depending on what type of hedge fund, whether it's equities, whether it's credit. It's their ability to go short, to use derivatives, to have more flexibility, to use leverage. All those per se put a different perspective and spin on quote unquote a hedge fund. Maybe another question I'll have related to that, and maybe to outline the difference and uniqueness of hedge funds to other quote unquote alternative strategies, whether it's private equity, VC. Usually those would be very concentrated, and the portfolio manager is really taking a strategic bet, likely with that one company, long only, very concentrated, and really that's going to be the company they're going to run with in that given asset class or theme. So they're really, really buying into what they're investing in. What makes hedge fund managers unique, and I think among the most interesting people in terms of to talk to, is they're very much driven by data, by information. They, in theory, should not have the emotional connection that maybe other alt investments have. They could short. They could do very different in terms of their in and out, and sometimes by the day. So I find that aspect intriguing about hedge funds. It may not be good for the tax picture. We're going to get to that a little bit later. But from your perspective, having been in the industry for years, what would you add to that?
I think you're absolutely correct on that, Angelo. I think a very important aspect of active hedge fund managers is their ability to decide on a much more frequent basis and actually understand that they may have made a decision in light of new information that is not in the best interest of the portfolio, and hence be able actually to exit those positions. Unlike private equity or venture capital, where the liquidity profile of those type of investments make it near impossible to actually effectively reduce your risk, i.e. remove that position from your portfolio during the active life of holding it. Hedge fund managers have that ability, either if they're computer algorithmic driven and very data oriented, almost on a second by second or millisecond level, but then even fundamental long short managers have that ability in light of new information, whether it's your typical quarterly information or information that they've garnered through some of the newer techniques that they're utilizing in terms of data analytics, to understand that maybe we didn't make the right decision, but conversely may have more conviction and may actually increase that conviction size. And so portfolio position sizing, as we mentioned a little bit earlier, is a very important aspect of risk management. And so in the case of your example of one company or one security that's being held by a venture capital or private equity firm, that is a tremendous amount of concentration risk. And so in the case of hedge funds, they are able to reduce concentration risk or increase it depending on their conviction levels.